You're listening to the Breakthrough Investor in Commercial Real Estate Podcast. Brought to you by MVP Equity Group, where we learn from private equity experts, their mindset, and ways to achieve financial independence. Here's your host, Ernest Peralta.
Ernest Peralta here, and welcome back to another episode of the Breakthrough Investor in Commercial Real Estate. Today, our guest is Matt Burk. Thanks for being on the show, Matt.
Thanks for having me, Ernest. I appreciate it.
Yeah, you're welcome. Matt is the founder and CEO of Fairway America. His company is the foremost authority in the U.S. specializing in the field of non-institutional size small balance real estate. Matt's played a leading role in the architecture and creation of more than approximately 200 SBRE funds for SBRE Entrepreneur since 2012. And finally, he's the author of a book called Capital Attraction, the Small Balance Real Estate Entrepreneur's Essential Guide to Raising Capital. So this is a very important topic for all of us that are involved in syndicating commercial real estate. So Matt, again, I'm grateful to have you on the show.
Yeah, my pleasure.
Great. So real quickly, after reading your book, I know a little bit about you, but for our listeners as well, it'd be great to understand your backstory and what did you do before you got into real estate?
Yeah, well, it seems like I've been in real estate more or less my whole adult life at this point. I got out of college. I went to work for a finance company, Household Finance, which is an old, consumer finance company, and kind of cut my teeth there. And we did some second mortgages, things of that nature, and kind of liked the whole real estate concept. I went to work for a couple of banks that did some mortgage lending, and ultimately started my own company in 1991, Fairway America. So we've been around close to 30 years now, and it's been a journey and an evolution ever since. But it seems like I've been doing real estate forever at this point. So
very well. Yeah, it sounds like you started pretty early and you stuck in the game here, and you've seen the ups and downs and trial and tribulations of the market.
Yes, indeed. Yes, indeed. It's got the battle scars to prove it.
Yeah, well, a lot of us haven't been in the game that long, but we've started seeing it. At least I started to see it once the 2007 recession hit. So I had a little bit of the scars then.
Yeah, well, those were some interesting times, some scary moments, but yeah, I guess like they say, what doesn't kill you makes you stronger. So
yeah, exactly. So could you please define, what is an SBRE entrepreneur?
Yeah, well, we kind of coined that term, and I think we define an SBRE entrepreneur or small balance, or we're actually using the term middle market more these days. But a small balance or middle market real estate entrepreneur is anybody who's running a business that requires them to raise capital from investors on an ongoing basis in order to capitalize that business. So people who are buying, fixing, and flipping houses, people who are making private money loans, people who might be buying commercial real estate, anyone whose job it is to go out and find real estate and to capitalize that transaction that raises money from investors to do it in a syndicated format or in a fund format is somebody I would call a small balance real estate entrepreneur.
Okay. So most of us that are listening on the show are we fall within that category. Okay. And so what mistakes or high price lessons did you overcome, while being an SBRE business entrepreneur yourself? And what did you learn from it?
Oh, yeah. Well, at this point, there's been many lessons over a long period of time. But, I'd say if I had to put some at the top of the list, it's just always acting in the best interest of the people whose money it is that we're taking, and treating that money as if it was my own. I've sort of done that from the beginning. I think if you do that, you tend to make fewer mistakes than if you're out there's a lot of people who can get good at raising money, but they do it more for the money and for the fees than they do for the investors. And those are the ones that end up getting into trouble. So I think a lot of what I was writing about in my book and, what our whole business model has been built on is really trying to help sponsors understand what it means to and what they need to do in order to be good stewards of people's money and how to do a better job of attracting capital, but being worthy of that capital. And that's really what we focused on with both Fairway America and our other company, Veravest.
Okay. And so from my perspective, I'm a GP as well, and I'm a syndicator.
Mm-hmm.
So I'm really interested to find out then from you if we can kind of step through, this thing that you talked about in the book. You talked about the SBRE Investor Continuum. Can you explain a little bit about how that works and how a potential investor can, start to raise capital from that way?
When I hear investor, that connotes to me people who are putting up the money as opposed to the sponsor, who's the person who's actually doing the deal, right? So if I'm, depending on which constituency I'm talking about, there's a lot of things I might cover for that. But when I refer to the investor continuum, I'm talking about if you're a sponsor raising money, there's a variety of different types of investors you can raise from, right? And I'd start on let's say the left-hand side with the smallest, unaccredited investor who is investing very small amounts of money, all the way up on the right-hand side, let's say, to the largest institutional limited partners like, the California State Pension Fund, and then everything in between from, accredited investors to family offices, and there's endowments and there's foundations. And there's pension funds. So there's all types of different investors. And I think where I go there in the book talks about when sponsors are trying to raise money from those different constituencies, there's different ways to do that and different approaches. And there's different probabilities of actually being able to attract that kind of capital, depending on what stage you're at in your evolution. And I just think a lot of people early on, especially when they're small, make the mistake of thinking that somehow they're going to go raise pension fund or institutional money and get discretionary capital, that they're going to be able to go out and do whatever deals they want without the approval of the investor. And that's just not reality. So, I try to debunk some of those myths and provide some guides to people around, okay, what can you do to get better at raising more money if you have deal flow that, you believe are good transactions that can produce the right return. So, yeah, that's what I mean by the investor continuum.
Okay. And, in chapter 6 of your book, I think you talk through the importance of a written capital raise strategic plan. Do you mind kind of talking a little bit about that?
Sure. Well, mostly I am encouraging people to have a plan. I think a lot of people, especially, we've set up, as you mentioned in the intro, Ernest, a lot of funds for people. Mm-hmm. And my general experience is that people think that if they have a fund that somehow magically the money is going to start showing up. And, I ask people all the time when they call us to say, hey, would you help us set up a fund? And my first question is, well, why do you want to set up a fund? Say, well, I want to have the money available so that when I find a good deal, I can act quick and, put in the offer and have a quick close so I can get a better price. And, I just want to have the money there. And I go, well, what makes you think that having a fund, it means that the money is going to be there? It's harder, in my judgment, to raise money for a fund than it is to raise money for an individual transaction, because people are investing in a vehicle with unnamed assets that they've never seen before. That's a higher bar than investing in a deal where you can point to, okay, we're going to buy that property on that address, right, with these characteristics. So in order to do that, I encourage people develop a plan on how you're going to go about raising the capital if you set up a fund, and be clear on where that, what those plans are. And I'm not saying there's a perfect plan or that everybody's plan needs to be the same, but I am saying that you need to have some idea of how you're going to go about raising the capital in a pooled fund format if you're going to go out and take the time and effort and spend the money to set up that type of a fund.
Yeah. Okay. And when we talk about an individual syndication versus a fund, can you explain a little bit more about what does these funds typically entail? Various asset classes, I'm assuming. What would be a typical fund?
Well, the basic definition in my world is a syndication is one property or one entity with multiple investors, right? So you're going to buy a single asset, and in some cases it might be a portfolio of a handful of assets, but it's a finite single transaction set up for a one-off deal, and it might have 6 or 8 or 10 or 75 investors in that syndication. A fund is where you have multiple investors and multiple properties that aren't necessarily identified at the time that people are committing to put the money into that vehicle. And that fund can be open-ended or it can be closed-ended. There's differences between the two. But that's what I mean by a fund. In terms of asset classes, to your question, they can be all types. I mean, it can be a super broad mandate that can do all kinds of different things, or it can be an extremely narrow mandate where you're only going to buy, one type of asset and be very disciplined on what it's going to be and everything in between. So, there's a lot of myths and misunderstandings in my experience that people have around funds. And that's a big part of what we've done the last 10 years is, try to help people navigate that and help them understand what the realities are as opposed to, what they think they're going to be.
I think that's a great point. A lot of folks that are out there, and thank you for defining that for me too as well. So I think that's very helpful for our listeners just to get that definition straight. Another question I wanted to ask you is you mentioned briefly in your book why unaccredited investors are not a good long-term source for capital raising or for fund managers as well. Can you kind of touch on that just a little bit and as to why?
Yeah, and I'd qualify that statement. I don't mean to say that it's not a viable source. I think it can be, and I think especially as that book was written in 2016, so 5 years ago, and obviously a lot of things have changed technology-wise in the last 5 years. And I think unaccredited investors investing smaller amounts of money are becoming an increasingly large part of what's happening with crowdfunding and other developments in technology. But I think at the time that I wrote that, a lot of it had to do with just for people who it really depends on the size of the transactions. I mean, if you're buying houses and, the dollar size is pretty small, I think it'll work out fine. But if you're buying big commercial properties in the millions of dollars, it's just very difficult to raise money $5,000 at a time, or $2,500 at a time and raise enough money to close consistently on bigger transactions. There's also a much higher regulatory burden on unaccredited investors because I won't bore you with securities laws and I'm not a lawyer, but I certainly have spent my fair share of time, understanding what the laws are. And it's much higher when you're dealing with unaccredited investors than accredited investors. So the dollar amounts are bigger, the regulatory burdens are lower. It enables you to do bigger deals. But obviously there's fewer of them. So there's trade-offs, right? Yeah,
exactly. And I think you hit a key point there. It just depends on the deal itself. Of course, you don't want a large deal that costs, say $20 million and you're allocating or trying to fund, $10, $15, $20,000 from each investor. That's going to take a long time.
Yeah, so, you do the math and it doesn't work very well unless you have an incredibly efficient operational, structure, which most small balance real estate entrepreneurs don't. Although, they can now go to crowdfunding sources if the deal is good enough and they can pass muster on the underwriting and have somebody else do it for them. So, nothing's static, right? Technology is rapidly changing the landscape in the financial world. And, some of what I wrote 5 years ago is not as applicable as it was then.
Right.
Today.
So what are the people that have been most influential, to you as you were running your business and in this industry?
Oh, there's a lot of individuals I've met through the years in the business that have had an impact on me. I mean, one of my first bosses at the thrift I worked for in California was a meaningful. This guy's name was Frank Landini, and he's passed away by now. But he was very influential. I mean, I read a great deal, so Warren Buffett's been a big influence, and a lot of other personal development people. Along the way, Earl Nightingale and some of those types of names. There's been a lot. I think my business partners have certainly been, big influence on me over the years. And I'd say that's both positive and, early on, not so positive. So I asked battle scars, right? I mean, some of those mistakes I made early on, I don't make anymore, but So I don't know if that answered your question.
Oh yeah, that answered my question. Thank you. And what projects are you currently working on now?
We have a lot of different deals we're working on. I think one of the biggest ones right now is we're partnered up with a group working on acquiring hotel and motel properties and converting them into workforce multifamily housing.
Mm-hmm.
So we've done 5 or 6, 7 deals there and got another 10 or 12 in the pipeline. So that's been a big focus of ours the last year or so. We're doing a fair amount of industrial product these days. We really focus on the middle market. So, to the term small balance real estate, we're focused on, I'd say, sub-institutional size equity checks. That generally means 2 to 20 million. And I'd say the maybe $5 to $10 million equity check size is a kind of a sweet spot for us. So, we're really at the core value-driven investors, trying to find real estate at good prices, at a good basis that's fundamentally quality property, but maybe for one reason or another we can acquire it at less than its intrinsic value, and that's harder and harder to do these days with all the capital in the market chasing yield and chasing real estate deals. But we got a lot of relationships around the country. I mean, the funds that you referred to that we've helped people set up, a lot of the reason we've done that is because it gives us insight into the way people think and the kind of deals they're doing. And it functions as an origination platform for us to find deal flow that we can invest in out of the funds that we manage. So we syndicate individual transactions, and we also manage a number of funds that are both open-ended and some closed-ended, depending on the strategy.
Yeah. Okay. With everything going on right now, I know things are changing, landscape's changing at a rapid pace. You just mentioned there about hotel conversions, and I'm starting to see those happen, right now, especially for that particular group. What trends do you see happening this year and for multifamily real estate investing in general?
Well, I think continues to be an attractive asset class. I think interest rates being low as they are, and the difficulty in finding yield elsewhere, and the readily available debt for multi makes it a super attractive asset class. I think multi has held up well, largely to COVID. Inner city or urban, newer Class A urban apartments have struggled a little bit, and I think they will for the next year or so, but I think they'll recover over time. So multi continues to be a super attractive asset class. I mean, it's hard to find yields on that, but people view it as extremely safe product, and people understand it well. So I just see a lot of capital continuing to flow in that space, and finding deals at attractive yields is going to be hard to come by in the multi space. But that's that. We're looking at multi, but we're particular, so it's hard to find anything that meets the criteria. We are looking at a lot more industrial, and the multi we are doing is largely the conversions.
Mm-hmm. Okay. In industrial, are you looking at mixed use type of retail space or warehousing and things of that sort?
Yeah, warehouses. Yeah, small industrial, again, non-institutional size. I mean, sometimes we'll get some bigger deals and we'll do some sale leasebacks, but true industrial type product and some flex. I'd say we're not doing a whole lot of office or retail at the moment. We certainly would consider those distress is always we've been in that business for a long time, so love to find good distressed opportunities, but they're few and far between, and there's a lot of capital chasing them. And I think you haven't really seen the full hit of distress yet and I'm not even sure it's coming, right? Because COVID is starting to wind down and everybody's getting the shot, and it seems like the economic recovery is already here and going to gain steam. So it'll be interesting to see the impact on the real estate sector, but I'm generally bullish on. I think you're going to see a lot of continued interest in the real estate sector in the next 3 or 4 years with all the money that's in the system now. It's just hard to imagine that, especially if they keep interest rates low. I just think it's going to continue to be very, very competitive.
Yeah, I don't see any end anytime soon. You keep hearing speculators talking about how we're going to run into a crash and we're going to see a lot of foreclosures that are happening, but I don't see anything yet. So nothing, at least in the interim or immediate horizon.
Yeah, I don't, I mean, I don't pretend to have better crystal ball than the next person, but I don't see anything that would indicate a crash. I mean, when COVID first happened, I really did expect it to be worse than the 2008 to 10 period. But it's turned out to be that way for certain people and sectors of society where there's been government mandated shutdowns on certain types of industries, right? But aside from those specific targeted industries, by and large, everything has held up much better than I would have expected it to. And at this juncture, with COVID starting to, with the shots starting to take place and mass immunizations and all that, I just don't see the distress coming that everybody thought was going to happen.
Right. Well, we'll see. Time will tell. But so far, at least for the foreseeable future, everything looks pretty bright.
Yeah.
Yeah. So
I guess it depends on who you are, right? If you're a buyer or a seller. I mean, if you're a seller, people have held out pretty well. And, I think there's been a lot of money that's been put on the sidelines and accumulated to take advantage of distress. And so I think there's a lot of money waiting to jump on it. And it just hasn't really happened yet.
Yeah, that's true. It's interesting. And so what work habits do you swear by, for the source of your success?
Well, I mean, I work pretty hard and I enjoy what I do. So I think, I like to get up early and I like to get started early. And that's like, what is it, Benjamin Franklin, early to bed, early to rise, man. I mean, it's trite, but true. And, but try to have balance in my life with my kids and my wife and other things I like to do. But, for us, it's generally 24/7 in terms of, paying attention to what's going on in the business, and kind of like you almost have to be in today's world in the United States to stay competitive.
Yeah, exactly. There's just too much information out there not to keep track on these things. And, you mentioned something there, being an early bird. Just curious, how early do you wake up in the morning, or what time do you start?
Yeah, I'd say I got up today at 5:30, and that's a little bit late for me. So, a lot of times 4:30 to 5 is a good start. 5:30 or 6, a little on the late side, but I'm getting older, so need my beauty sleep.
That's great.
Not working, as you can tell if you're watching live.
I'm actually the same. The reason why I ask is because I try to be an early bird as well. I hear through other successful individuals that waking up around 4:30 is kind of the norm. So, I kind of implemented that a few years ago, and it's something that you get accustomed to. I don't know if you do any other things such as meditation or, exercise in the morning, but those are things that I've gradually implemented into my routine. So
this time of year, I ride a road bike. So this time of year, when it gets light out at 5 o'clock, I try to be on the road at dawn, and that's always good. You get a 2 or 3 hour ride in before work, and get to the office by 8:30 and feel really good.
That's good. Yeah. Well, great. It's good to know that there's another early bird riser here too, as well. So what is one common myth? I think you kind of talked about it too, about being a real estate investor that you would like to debunk. I don't know if you wanted to elaborate on that again a little bit more.
Yeah, I mean, again, if I'm talking about the passive investor who's putting money in with the sponsor, I think I would tell you that I see a lot of charismatic people who are good at raising money, but really aren't that good at doing deals and being a good steward of that money. So I'd say don't judge a book by its cover. I think a lot of people invest with people that, as I'll call us professional investors. I mean, I've seen a lot of our investors put money with other people whose deals I've looked at deeply that I wouldn't touch with a 100-foot pole. Mm-hmm. And that seems to happen consistently. So sometimes the best capital raisers are not really the best real estate operators. So I think, but it's hard for an individual passive investor to do homework on any given sponsor is incredibly difficult because they don't if you're going to invest $50 or $100,000, you can't command enough responsiveness from that sponsor most people don't have the inclination or the time or the expertise to actually do the necessary homework on those people anyway. And frankly, that's all of why we run Verivest, which is the other company that we have that tries to help investors do that for them. Right? It allows competent, capable sponsors who might not be the most charismatic people to prove that they're solid, that their background check is clean, and that their track record is verifiable, which is incredibly hard for investors to be able to do. So I think don't judge a book by its cover is my admonition.
Yeah, I think having that other company, like you mentioned, Verivest, I think their business methodology is great just in terms of helping individuals that may want to get into, becoming a passive investor, or even just co-partnering or co-GPing, just really understanding the people that you're dealing with and learning more about their background to see if they check out to be the people that they say they are. So.
Yeah, and what might come as a shocking revelation, Ernest, a lot of people will make claims that are not verifiable. And it's very difficult for the investor to know, which one is, full of it and which one is actually able to prove that the IRRs that they have in their pitch deck are legit and not just numbers on a page that are fantasy.
Yeah.
Which, having looked at thousands of these sponsors and deals over the years and asking people to prove it, I'll tell you that a very high percentage cannot be corroborated.
Yeah. I think that's just an added protection, added layer that passive investors should take advantage of, or at least consider.
Part of the mission that has driven us since we started, this iteration of the business after the last downturn is, really how can a sponsor who's really a good steward of that money do a better job of raising capital from investors, and drive more capital to the people that deserve it and away from the people who don't really deserve it, right? Who are claiming things that just aren't reality. But they look good and they sound good and they have more of a capacity to, get investors to part with their money. I mean, that's kind of at the heart of it.
Yeah. That's a good way to actually sift through the clout, if you will. That'll definitely distinguish the people that are actually, well, not to say legitimate, if you will, but it'll definitely distinguish the people that are more credible than not.
Yeah, I had an interesting anecdote the other day. It's a client of ours that we've worked with for 6 or 7 years, and they manage a lot of money. I mean, they've raised probably $300 million from investors, and he told my partner the other day that this is the first time he's ever been asked to have a background check done on him. So, I mean, they've raised $300 million from investors, and no one has ever done a background check. And that just goes to show you that, the individual investors simply either don't ask or don't have the clout to command that people would do this. So now in his case, I mean, he's a straight up guy and we got the background check and it's fine. Right. But the fact that nobody ever asked for it. I mean, I've run plenty of background checks on people that have come through here to looking for, a co-GP or us participating in their deals that have raised plenty of money that we won't touch. Mm-hmm. But most investors don't. They can't. It's almost impossible to do that. So yeah. It's a dangerous world out there, and I think developing tools to help people make better decisions and do things for them that they can't do for themselves to improve the likelihood. I mean, you can never completely get rid of all fraud, right? I mean, people who are completely hell-bent to rip people off or can get pretty good at doing it, right? But you can catch the vast majority of it with some very simple things that are hard for individuals to do, but that can be done collectively. So
yeah, I think this is almost one of those where you need to put it on a checklist and make sure this is one of the things that you check off and make sure that you accomplish.
Yeah, exactly.
Yeah. Well, great. How can our listeners connect if they wanted to find you?
So we go to our website, fairwayamerica.com, and my email address is matt.burk, B-U-R-K, at fairwayamerica.com. It's the best way. Reach me through email and check out our website.
Oh, perfect. And last question. What actionable advice have you learned is the most important action or pattern of behavior that a new investor must take or do in order for them to take the next step towards their goals?
Yeah, and I think, well, for sponsors, I would say is, be clear on what it is that why you're doing what you're doing. So I think a lot of people rush in and they think they want to do something, but they're not clear why. So always ask why first for sponsors. And I think for investors, it's make sure you know who your counterparty is. Do what you can to make sure that the people that you're giving your money to are worth giving that money to.
Well said. Thank you, Matt. And so that is all the questions I have for you. I just want to say, to our listeners, when you get a moment, go ahead and grab Matt's book, Capital Attraction. It's a great read. I definitely think that it's worthwhile, especially for those that are trying to get into syndication or wanting to raise capital for their business. And definitely pick it up when you get an opportunity to. Thanks again, Matt, for being on our show. Really appreciate it. A lot of good information. And thanks everybody for joining. Until the next time, take care. Thanks for listening to the Breakthrough Investor in Commercial Real Estate podcast. If you like what you heard and you found value in this episode, we would really appreciate if you would give us a rating and a review. And don't forget to subscribe so you don't miss the next episode. For those of you that are interested in investing passively in these types of deals in solid cash flowing commercial real estate throughout Arizona and Texas, as well as Idaho and Colorado, then visit us at mvpequitygroup.com. Fill out the investor interest form. That's mvpequitygroup.com. If you close on a multifamily deal or any other type of commercial property in the past 12 months and you want to be on this podcast, then send us an email on our Contact Us page for details. Thanks.